Hello everyone, I'm Lucy from OSL. Before we begin today's AMA, let me give you a brief introduction to OSL. OSL is Hong Kong's first licensed crypto exchange recognized and approved by SFC. We are also the only publicly listed licensed crypto exchange in Hong Kong. We offer the industry's largest crypto insurance coverage, up to $1 billion USD. With reliable HKD USD banking channels and zero transaction fees, we provide users with secure and fast deposit and withdrawal services. OSL is also the largest custodian for spot crypto ETF in Hong Kong, holding over 70% of the market share. At OSL, we focus on openness, security, and compliance, always striving to provide institutional and retail clients with highest standard of digital asset services.
Hello everyone, I'm Jack and welcome to another episode of OSL Talk with Jack. And today we're going to look into the Bybit 1.5 billion hack, insights, lessons, and the future of crypto security. On February 22nd, 2025, close to midnight, several blockchain analysts and researchers on X shared a concerning update. They reported abnormal transfers from Bybit co-wallets involving a large amount of Ethereum being sent to multiple unknown wallets. The value of the transfers was estimated to be nearly 1.5 billion US dollar. Shortly after, Bybit CEO Ben Cho confirmed that the exchange has been hacked with a loss of around 401,000 Ethereum. And this is the largest hack in cryptocurrency history and the biggest theft in human history. So the hacker now holds more Ethereum than even the Ethereum Foundation or Vitalik himself. So how were the hackers able to breach the security systems of one of the world's leading exchanges and steal such a massive amount of funds? What are the latest developments in the situation? And what lessons can the crypto industry take from this incident? And today, we're going to invite four top industry leaders to deep dive into the details of this incident and update us on its ongoing developments. Our goal is to help the industry and users better understand security risk, protect their assets, and advocate for stronger security practices across the entire ecosystem. We have invited four top industry experts to dive deep into the details of this incident and update us on its ongoing development. Our goal is to help the industry and users better understand security risk, protect their assets, and advocate for stronger security practices across the entire ecosystem. Now, let's welcome today's guests. First, we have Gracy Chen, the CEO of Bitget. Hello, Gracy. How are you doing?
Hi, everyone. I'm good. I'm in East Denver, for East Denver. So hopefully I'll spend some good time this week. Not just chatting about Bybit, but about how we can grow the whole ecosystem together.
And the next we have is Gary Tu, and the Executive Director of OSL. Hey, Gary.
Hey, Jack. Hi, everyone. Great to talk to you.
Thank you for coming on board, Gary. And also we have today Markus Thielen, the founder of 10X Research and the author of Crypto Titans. Hey, Markus.
Hey, Jeff, for having me, and everyone, looking forward, excited to be here.
Thank you for accepting our invitation. And looking forward, I haven't got your book yet, but I'm looking forward to get one soon. So you're probably going to send it my way?
Sure, I can send you a copy, no problem.
Thank you, Markus. That's very kind of you. And Blue, who is the partner and CTO of SlowMist. Hey, Blue.
Hello, everyone. Nice to meet you.
Is blue your favorite color? Because you're in blue today.
Yeah, my favorite color. Yeah.
I'm in blue today, too.
As long as it's not Monday, for me, blue is fine.
That's right, Markus, yeah.
So together we addressed the critical issues surrounding the Bybit hack, as well as its aftermath and how the industry is stepping up to ensure stronger security moving forward. So we're going to start right now. So Lucy, the ball is on you.
Awesome, Jack. Thanks for the intro. So I guess the first question will be for Markus, founder of 10X Research. We're happy to have you here. We have noticed a significant market drop yesterday, just a few days after the Bybit incident. What are the key factors you believe contributed to this market drop? Do you think it has a link to the Bybit incident?
I mean, we were already trading relatively weakish, I think, for the last couple of weeks. And I think the key factor here is that it seems that US-based hedge funds who are very long, the carry trade, basically long spot, probably through ETFs, in short, the futures to pocket the yield, they probably have been unwinding over the last couple of weeks. So there was a bearish moment already. And I think we tried to rally after the weekend. I think Ben handled it, quite well. I think there was a lot of positive feedback. But of course, at one point, the market thought over the weekend that, Bybit has to buy back $1.4 billion in ETH. And I think when he announced that, we already bought it back, then I think then the market started to sell off. But, what we have seen basically since the mid-December FOMC meeting is that basically retail volumes have, compressed. With it, the funding rate, and with it really the spread that hedge funds could pocket. And when we look at that, hedge funds, based on our calculations, have probably account for something like 55% of all the Bitcoin ETF inflows really. So they're more neutral than really long only money. And I think we have seen really that they're trying to unwind this over the last couple of weeks because of the funding rate has really compressed to just single digit, and it's not really attractive for them anymore. And so, for example, we have seen also that the CME has seen open interest decreasing by 12 billion. On the flip side, of course, MicroStrategy has been buying. So I think there has been a switch from the hedge funds to Michael Saylor, to MicroStrategy really. But I think that has really run its course. And I think when we broke certain technical levels, so one level was, of course, the 95,000. When we broke this, I think then we saw a wave of selling, and the average entry price of short-term holders, 155 days, is around at 92,000. So when we broke that, I think we made another leg lower because people were stopped out. So I think we saw liquidations based on technical levels, based on a lot of supply overhang from hedge funds, and I think that's what brought us lower.
Wow, thanks so much for this breakdown, Markus. I'm excited to hear your point of view in how you would see the market going in the next few months. But I will keep that question to the end. Right now, I'm handing the mic over to Jack.
My next question will be for Gracy, and it's going to deep dive into the crypto's cash machine. So, Gracy, you mentioned that that's a 1.5 billion represents Bybit's annual profit. And Bybit has the capability to reimburse its user on your Twitter. So 1.5 billion is a lot of money, which translates to maybe about 3.8 million daily for mass investors. And this raises a critical question: is that why are central exchanges so profitable? And how does this compare to traditional financial institutions like stock exchanges or payment processors?
Sure. I want to focus or reiterate that that's more of a personal estimate. It's not, fully confirmed from Ben or the centralized exchanges. It's more based on the fact that I think they are very solvent even after the hacking. But it doesn't mean that it's a very accurate number. I don't have the access to their financial balance sheet, things like that. But the things or the key things about profitability of centralized exchanges is that crypto is a 24/7 global instant settlement kind of business, and that drives lots of our revenue. If you look at the breakdown of the income streams of centralized exchanges, there are derivatives, spot market, there are staking, there are structured products. And those everything all add more value streams than traditional stock markets. And if you look at Bybit and Bitget, and of course Bitget started in about 7 years ago, and when we just started off, we are definitely not that profitable, and there were a period of time that we are nearly to bankruptcy or just had a very hard time, especially during the bear market. And definitely, even in 2025, after lots of crypto-friendly frameworks coming up in the US, after ETF is approved, there are so many exchanges, but not every exchange is very profitable. There's still smaller exchanges surviving or near bankruptcy. And Bybit, Bitget, we are big. We are top 4, even top 2 if you include all our Bitget wallet users, etc. So we're a very big ecosystem already, and that's why you see good profitability here. But all those money that we earned, we also invest back. Like we reinvest in our security, compliance, and user protection. I also do some CSR program, like I initiated Blockchain for Her and Blockchain for Youth. So it's not just about profitability; it's about how you are profitable, can earn money, but also give back to give your users a better experience in terms of security, in terms of the user experience. And our goal here is to sustain the profitability and have a very strong proof reserve backed sustainability, not just achieving solely high profits. And high profit is never the goal; it's more of a result.
I see. And I would say that is very well managed, more than it's very, very profitable. Am I right?
Sorry,
to say that?
what is well managed? You mean company is well managed?
Yes. Yes,
Yeah,
the exchange
great.
is
Yeah.
very well managed. Yeah. All right. Thank you, Gracie. And the next question will be on the core wallet. And according to CEO Ben Cho of Bybit, the Ether core wallet was the only one that was attacked, and all other wallets of the exchange were unaffected. So core wallets were supposed to be really safe. How has this changed? Blue, you want to answer this question, Blue?
Okay, yeah, I can answer the question. I think about the cold wallet bridge, the Bybit, as they said, they use cold wallet, they use Ledger and Safe Wallet to organize the access in cold wallet. But yeah, for this incident, they were hacked. Even they use cold wallet. I think there is a problem. I think maybe because they involve the safe wallet, it is not their inside the system, and they can't control safe wallet. So if the safe wallet UI show the wrong things, maybe they can find so at the incident. So I think I suggest them they can use a better code wallet like Ledger is good enough, but I think if they can show the details of transaction, maybe they can check it more carefully and there's asset and more safe. I also suggest that they can split their asset to a lot of different code wallet. So even if they were hacked, only one part of assets were hacked. Okay, so that's my suggestion.
This is one question which our audience will be eager to understand, is that how did hackers manage to successfully breach the world's top three exchanges? And as far as, could you break down the details for us? Blue?
Okay. For now, we didn't know the whole details. We just know that the hacker found a way to change the details on Safe Wallet UI. Maybe the Safe Wallet UI is a fake one. Maybe they found a vulnerability on Safe Wallet, so they can uh, replace the content on Safe Wallet. So, but for now we can't know the reason. We just think about it. Okay. So, and about the ledger part, I also think because when as Ben said, when he signed the transaction, he can't know what is the content on ledger. So it is also a bad idea. Okay, so even he didn't know what the content is, I think he can't sign the transaction. Okay. Okay, maybe that's the reason.
And this leads to the next question. So the next question would be like, what happens if a central exchange doesn't have enough liquidity to support withdrawals? Are there differences in how jurisdiction handle such cases, crises? And in Bybit's case, if they couldn't cover withdrawals, what would happen? So this question will have Gary too, the executive director and head of regulatory affairs of OSL. Could you share your insights on this, Gary?
Sure. Thanks, Jack. That's a very good question. So I guess in the current global landscape, you try to pick a handful of CEXs and try to make a general statement about them. It will be a difficult thing to do, especially when you're talking about the areas where the CEXs may still be operating outside any regulatory frameworks. I guess in simple terms, we're talking about the possibility of comparing apples and apples and oranges with oranges. So, for example, any two unregulated exchanges, potentially they underlying them could be different legal frameworks, different jurisdictions. So, for example, in the case of Bybit, the relevant platform company is a BVI incorporated company. If you look at other CEXs, you'll probably find they may be different jurisdictions, so different legal frameworks in place. But let's not stray too far. So since I represent sort of the regulated kind of CEX landscape, if I was to look at a place like Hong Kong, right? So going to your question of what happens if there is not enough liquidity to support withdrawals. Conceptually, if we're not talking about hacks in the first place, regulated CEXs in jurisdictions like Hong Kong should never ever have a client asset shortfall in the first place, because client assets are segregated. They're held on trust, they're off balance sheet, and they also have to be segregated and held separately so that they're always identifiable and auditable at any given point in time. I mean, that's sort of like the textbook definition of how to draw a distinction between client assets and house assets. For example, I can't take client assets and go and buy coffee with it because client assets are client assets. But then let's also talk about sort of the issue of the losing client assets due to hacks or attacks or other cybersecurity threats. When it comes to sort of the regulated CEXs like what we have in Hong Kong, how we actually hold client assets are also highly regimented. Cold wallet usage is mandated. It's not just mandated in terms of having to use it. We have to use it for a very, very high percentage of client assets. In the case of OSL, all of our client assets are held in cold wallets. But I think as Blue quite accurately identified, cold wallet infrastructure without a good set of operational procedures around it can still open you up to a lot of vulnerabilities. So what happens in a regulated CEX? Segregation of duties, multiple layers of maker-checker controls, wallet whitelisting, multiple levels of approvals and limits, so that you can limit the blast zone in the event there is an incident of vulnerability. And I think Blue made that point. How to reduce the blast zone in the event something does fall over. And also multiple layers of wallet infrastructure. So effectively, you're increasing the difficulty for a would-be hacker to actually get to what's valuable. So these are in place to minimize the risk of incidents occurring, and also sort of to use your wording, Jack, to minimize the possibility of not being able to meet client withdrawals. Now, but let's say all of these things also fall over, then what happens? Well, so for example, in the case of the Hong Kong regime, we also have mandatory insurance coverage requirement. So right now we hold more than $1 billion of US of insurance coverage. So this is in the event that a very significant hack happens, and we need to look at insurance claim to make sure that we also have the ability to pay out to the clients who may fall victim to such an incident. So I think when we talk about CEXs, we should never just talk about one type of protection or one layer of defense. It's really all the different layers of the onion that that potentially these incidents would have to get through before before you really get before you really get something majorly disastrous happening, such that the clients would actually be at risk.
Thank you, Gary, for your insights and the same question. And I would also like to ask Bitget CEO Gracy that if Bitget couldn't cover withdrawals, what would happen?
How would Bybit? You mean Bybit?
Sorry,
in this case, right? Yeah.
Yes,
or I guess in general, any centralized changes. So if you look at what happened in FTX, I think that's exactly or the key reason that FTX went bankrupted, at least according to BTC or Ethereum. Well, because Bitcoin was a lot cheaper 2-3 years ago when the tragedies happened around FTX, and now they can cover Bitcoin, Ethereum, etc., and all the cryptocurrencies that the users had according to their previous price. But it shouldn't be the case. They should give the users Bitcoin and all the cryptocurrencies at that time rather than now according to that price. So if we look at what happened in FTX, Central Exchange went bankrupted, and that hurt a lot for the industry. And that's exactly a risk that we saw Bybit might have, because like I said, I think profitability wise, they are healthy. They shouldn't have a problem in the long run, but there could be short-term withdrawal crisis if they don't have enough Ethereum, because those are the Ethereums that they got stolen. And that's why we gave them a bridge loan of 40,000 Ethereum. We can dive into that a bit deeper later. But in terms of your question, I think as an industry, we need to prove to our user that there is enough, withdrawal, and that your money is never commingled. And even for user, you need to see that proof. You shouldn't be just trusting anyone. Even when Gracie say, okay, we will cover it, or Ben say, okay, Bybit doesn't have problem. You need to prove, you need to let your users do withdrawal after they heard what happened to Bybit, the hacking. And for us, when there isn't hacking happen to us, we need to have proof reserve published on a monthly basis that your users have the concrete evidence here. For example, for Bitget, we published all our proof reserve and also our protection fund very transparently. Our protection fund are in open wallets that users can click. Like even right now, you can click to our Bitget protection fund page and see all the open wallets where we only have Bitcoin. Previously, I think had USDT, but we changed everything to Bitcoin right now. But basically, for us, our reserves say that, I think according to the newest data, we have about 300+% of BTC over our users fund, and USDT, Ethereum, USDC, all the major cryptocurrencies reserves show that we are always over collateralized. And that's the goal we want to achieve. And again, protection fund also ensure another layer of security without only relying on the reserves. So when a centralized exchange can't meet withdrawal, I think that's a very big issue. And if we look at the Bybit case, they handled it very well. They make sure that the users can withdraw and they stay healthy. By the way, I mentioned we gave them the bridge loan and they paid us back already. So it's, I would say, according to this action, their short-term Ethereum crisis, liquidity crisis was also fully solved.
Yes, Gracie, and this, leads to the next question will be, what was the strategic thinking behind offering the significant ETH bridge loan? And how do such action impact Bitget's reputation and the crypto ecosystem as a whole?
First of all, I wanna, because there are some misconceptions or misunderstandings about the situation here. There were sayings that Bybit and Bitget share the same largest shareholder. They were saying things like Bitget helped Bybit for PR reasons. There were also people who thought that we moved our users fund to help Bybit, which are all nonsense. I want to clarify that these are all untrue. Why we helped Bybit? Actually, to start with, we didn't really even thought about PR or anything like discussing this openly or in the public space. It's actually until there were I think some KOL accounts on Twitter who discovered that they basically monitor like major transfers, like big amount of crypto transfers, and they monitored it and they published that Bitget sent Bybit 40,000 Ethereum. That was about 5 hours after the hacking. The behind the same story is that when we heard the case, the hacking, and we asked Ben if he needs anything, and we actually proactively reached out to them rather than Bybit asking me for anything. And it seems that the Ethereum, because it was hacked, that was a major issue when they had like the withdrawals from the users, like they don't have enough Ethereum for short-term liquidity. Again, we thought, number one, we've all experienced FTX together, and we don't want to see our industry going through that again, because November 2022 for me, it's still a very tragic time. That kind of kicked off the very long bear market previously. And we don't want that to happen to Bybit or to our industry in general. And again, of course, we assess the risks. We think they are solvent and they do have enough profitability and money to pay us back. It's just short-term liquidity that they needed. And we do have the reserves to act. We don't need to move our users fund. And if we were to use our users fund to help Bybit, that we wouldn't do that, right? Why would I do that to Bitget or to our user, right? We will never use our users fund at all, not to say what to do anything with it. So we had the ability to help, and so we did. In my opinion, a more collaborating centralized exchanges landscape is very healthy to the industry. Like the fully competitive market should be, do benefit for users, for industry. And we are, partners and competitors in serving our users, but we are not competitors in security. Bybit is not an enemy. Hackers are the enemy for our industry. So in this case, we should stay together to make the market stronger, to make our industry more stable. And that's what we thought. And then, after the KOLs publishing the transactions and they questioned a lot of things, I stepped up to give everyone a full, more transparent picture about what we thought, about what we did, and of course, to clarify lots of things. But PR wasn't never the goal to start with. But of course, it earned us good reputation. It earned Bybit and Bitget, this kind of friendship is praised a lot in many occasions. But my goal here is to, help a strong and respected competitor and peer exchange. And in the the outer goal is still to serve the industry and to make our market more stable.
Thank you, Gracie. Very well said. And that's why they put it as a friend in need is a friend indeed. And the next question will be OSL, and how would OSL handle such a similar crisis? So it's for OSL. And Gary, and could you shed light on your internal procedures for handling a major security breach or liquidity crisis? And what steps would you take to ensure user funds are protected? And how would you communicate with your community during such a high stakes situation?
The funny thing is when the Bybit incident came to light in the news, we got a call from our regulators already, and I'll explain why this is kind of sort of relevant. Anything happens, one of the first places we get calls from is our regulator, to be very honest. And ironic that even when things happen to other people, we get a call from our regulators. Even when things happen to other jurisdictions, we get a call from our regulators. So you can pretty much think of every single major crypto incident or crypto sector incident in the last few years. We are pretty much standing by our phones, expecting a call from our regulators. So then, if something were to happen to us, well, no surprise, we're going to get a call from regulators. But to be honest, even before that happens, we would call them because we're actually legally obliged to. We have a self-reporting obligation under the Hong Kong regime to immediately report any major incidents affecting availability of our platform, affecting our cybersecurity environment, anything affecting our financial health, anything affecting our client assets. We have to self-notify, proactively notify our regulators. And if anything were to affect our clients, we also have a legal obligation to notify our clients. So in terms of level of transparency, I think there will be no question. We have to be out there. We have to be out there notifying people affected. We have to be out there notifying our regulators. In terms of look, in the hypothetical, really unfortunate case of things really happening, I guess one of the points we touched on earlier on is, okay, well, if I was an investor, if I was a client, and I was worried about whether I'm impacted, or if I truly am impacted, what do I do? So the CEXs, for example, like the ones you see in Hong Kong, like OSL, people know where we are. We're incorporated in Hong Kong. We're licensed in Hong Kong. Our address is public. In fact, also our responsible officers, i.e. the people who are legally responsible for the operation of the entity, are also publicly known in a public database. So from an investor's perspective, if they really had to take steps to protect their legal rights, they know where to do it, they know how to do it. And Hong Kong law is quite transparent in that respect. It's a common law system. Investors know how to exercise their rights. So look, I mean, and I think the market has quite correctly commented on on Bybit setting a good example on transparency, and we agree with that. Notifying the affected people proactively without delay, sharing information with them so that they for example, for them to have a peace of mind. And so in our case, that would absolutely be what we're required to do, and that's what we would expect ourselves to do. But we would also have additional steps. So, for example, we would notify our insurers, for example. If and anyone who drives a car knows that if you're involved in an accident, you call up your insurers. We would definitely be in a similar scenario. Would notify regulators, insurers, and our clients. So yeah. So I think overall, overall from the Bybit incident, it's actually quite a valuable case study for everyone in the CEX space.
Well, thank you for Gary for the breakdown. And next question will be addressed to Gracie. So Gracie, just one day after the Bybit incident, there is a famous AI Twitter account, AIXBT, tweeted, code GM Bybit is the next FTX. And this message has over 300K views. We would like to ask your opinion on this. How do you comment on this comment? Gracie.
Yeah, I think I mentioned that a little bit earlier, a little bit touched upon that topic a little bit earlier, but we can talk about that deeper. So I think it's totally different, Bybit and FTX. Number one, Bybit is had this crisis, and it's more of a short-term liquidity crisis due to hacking, and they can fully recover because they have real reserves there. And like I mentioned, we gave them some loan and they paid us back already. And even the short-term liquidity crisis, I think, is solved. However, FTX was total fraud. It was insolvent because they commingled their users' fund. The users' fund were misused in Alameda research, and due to very high leverage, they lost those part of those users' fund, and they can't pay back their users in total, at least according to, like I said, BTC and Ethereum at that time. They can pay back now, but according to the previous price when Bitcoin was only traded at about 20,000, which is unfair for their user, right? If their users hold those Bitcoin from that time, November 22 to now, they should have a 5 times gain already. So again, it was insolvent because of a fraud, but Bybit had a little bit issue because of a hacking. And this is a cybersecurity incident, not a solvency incident. What happened to Bybit could potentially happen to many central exchanges, and not just central exchanges. If you look at the past crypto space, issues in hacking, it's six central exchanges. There were DEX, there were DeFi protocols, smart contracts, etc. So it's basically the whole crypto space, because cryptocurrency, they have value. And they are all crypto and on-chain. It makes it more vulnerable to hackings, basically. And there are targeted groups like Lazarus and some other groups around the world who are targeting our whole crypto space. And that's why I think Bybit is not an enemy. Bybit is actually a friend, and we should stand together to fight our real enemy, which are the hackers here. Yeah, so it's totally different issue. Bybit and FTX, and I think for the past few days we've seen that cryptocurrency industry is stable. It has a little bit drawback from 95K ish in terms of Bitcoin price to where it is now, maybe 89, 88K. But it's totally not due to Bybit, and Bybit and FTX, they are totally different.
Thank you so much for the breakdown, Gracie. I think from this incident, we can also see how crypto industry is evolving very quickly and how it is anti-fragile. And talking about anti-fragile, we would like to address the next question to Blue. And what are your key takeaways from the Bybit hack? Because I have checked through the Ben's live show, and he really explained his team did everything they can. It's like they have the warm wallet, the cold wallet, the hot wallet segregated and is separated. And how did this still happen? And are there emerging threats that the industry isn't prepared for? Like what you just said, Ledger was not a good solution. So are there better solutions than Ledger? We would like to have your professional opinion on this. And I guess our audience will be eager to hear your advice.
I think I I don't think that ledger is not a good solution. Just in this case, because ledger can show the details of the transaction. So I think for this part, ledger is not a good solution. I suggest that about a cold wallet, you can use some other hardware wallet like many other brands I can see here, I think. So they have a big screen. They can show the details of a transaction. And they have also check the transactions for security issues at first. Like if they can check the function is not a transfer, it's a transfer control admin role to others. I think maybe we 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 won't sign it because we know it's not a transfer function. But for now, Ledger can't do it. So I think at this situation is not a good solution. So, and about the incident, because Bybit used safe wallet. Yeah, I said it before. Safe wallet is not Bybit inside the system, so they can't control safe wallet UI. Because if the safe wallet was hacked, if the hacker try to hack the safe wallet web and server, maybe they can replace anything, and they can hack a lot of assets from centralized exchange or many individual users. So so that it makes that their cold wallet is not cold enough because they still use third-party servers. So I also suggest that maybe they can build a system that based on a multi-signature system, but they can try to check all things, and they can use their developer to write their own system. So I also suggest that maybe MPC wallet, like a lot of system that for now a lot of centralized exchange they are based on MPC system because is that they can use multi-party signature, but they don't use like safe wallet, like control wallet, like they can control their access maybe in their inside the system, and they can control anything maybe, I think. So it's also a better way to check the transaction before they sign. Okay.
Thank you so much for your breakdown, Blue. And we would like to ask you, so do you mean that it's better for CX to build their own cold wallet system other than using a third-party supplier? Or do you foresee the CX who are using the safe system as the cold wallet would have huge risk for hack? Would you please elaborate more on this point?
Okay. Yeah. Yeah, I think because it's your cold wallet, I think you should keep it cold enough. So I suggest that you can't use third-party things for your cold wallet because if they were hacked and you were hacked, so it's a very bad situation that you can't control. You should check it carefully, and you should check third-party system carefully. So it's not your fault. Maybe if safe wallet was hacked and Bybit or other users were hacked, it's not their fault, but they were still hacked. So I suggest that maybe they can write their own system based on MPC solution or based on safe wallet solution. I think is also a good way because after they test the system is safe enough, is better enough. I think maybe they won't be hacked in the future. So I just suggest this. Okay.
Thank you so much for your advice, Blue. So next question will be for all of our guests. Imagine, because a lot of our listeners, they are maybe just crypto beginners, and I guess they would be very eager to know your advice because you guys are all crypto OG in the space. How should I invest, like based on my profile? Imagine if I'm a 40-year-old mom, or if I'm a 18-year-old student, or if I'm a 50-year-old grandpa. Like, how can I choose the right finance institution to invest in digital assets? Should I invest in DeFi or CX, license CX, or should I invest just in the Bitcoin ETF? We would like to have your personal point of view on this question. Shall we start with Markus?
Buying Bitcoin is probably the right strategy versus a lot of the altcoins, a lot of the more exotic trades, tend to lose out. While, a lot of people, of course, speculate in the altcoins, and some of the altcoins in a strong bull market can actually generate a lot of returns. But, historically, once a peak was reached, I think the altcoins have really struggled. I think we have seen this even with Ethereum, which, peaked in April 2021, and I think it made another brief peak in November 2021, but it didn't really make back to the old high. And even I think when you factor in the inflation from Solana, Solana also didn't really make a new high this cycle, despite all this hype, despite the pump.fun and everything. So I think in the end, the money is flowing to Bitcoin, and so I think having a large Bitcoin exposure, or the majority of the exposure towards Bitcoin, is probably the right strategy. And I think going with a with a large exchange, or going with a regulated provider, really, be it somebody who is regulated, be it the Bitcoin ETFs, I think that's probably like a good strategy. And I think you want to have a little bit the institutional backing, the institutional buying, supporting you. And I think we can, of course, identify there's a lot of institutions buying Bitcoin, and you want to have this tailwind, versus a lot of the altcoins have a lot of venture capital money needing to be selling these tokens, so there's a lot of unlock happens. So the inflation rate tends to be usually quite high, and I think that's why people get diluted over time. So I would just simply stay with Bitcoin, and be more on the safer side.
Thank you so much for your opinion, Markus. I'm really glad that you say that, actually, because when I explain to others, well, just buy Bitcoin is the most safe asset, and community, with the crypto community especially, will laugh at me to say, boo, you're boring, it's bad. So I'm glad you said that, having been in crypto circles since so long time. And great. So next, can we have Gracy's advice?
Sure, I just sent something in our chat, and that's basically a so-called high-level advice that I have for myself and my friends and family when they just started investing in cryptocurrency. As at least the majority of their shares should stay according to this principle, in my opinion. Like Lucy herself, I got actually kind of like lots of messages, just like overwhelming messages saying that Gracie, you shouldn't say this. Well, what I said was I would like to hold cryptocurrencies and assets that I can sleep soundly at night. So that's probably a good baseline. And for everyone, it means different things. People like me, I feel comfortable holding, for example, Bitcoin and BGBR platform token without any leverage for my majority of my shareholder of my cryptocurrency portfolio. For some people, it may mean that they are not okay with any currency, not even Bitcoin. So again, think about your own risk tolerance level. Think about your amount that you feel comfortable investing in cryptocurrency. But for the majority of the cryptocurrencies that you are investing, at least the majority of the portfolio, probably you don't want to do meme coins token trading. You probably don't want to do leverage. And as I posted here, even if you believe in the fundamentals, you want to wait for a good price. If you like Solana and Ethereum and you're still strongly bullish about those tokens, you may want to hold and wait for a better price to enter. This may sound a little bit controversial, especially given I'm running one of the largest centralized exchanges, which offer more than 800 altcoins to our users. But for me, a chef who likes fish, but their users or the restaurant attendants like for example chicken, you want to provide both, right? You don't. I, as the CEO of Bitget, I don't want to just offer cryptocurrencies that I personally like. That's unfair. We want to provide a good marketplace for all our users to trade, but we also want to be quite selective in terms of what tokens to list. And that's why you see today, when there are probably millions of cryptocurrency tokens out there, we have only listed 800. Even so, we are delisting some that doesn't have enough liquidity or that's not popular anymore. So this is a very evolving situation. But going back to your question, I would actually, kind of agree with Markus that Bitcoin is probably the largest and the best cryptocurrency if you want to start investing, especially if you're a new beginner. You can do ETF, you can trade at a centralized exchange like us, or you can use your, just everyone has different investment criteria, but I think thinking about risk tolerance level and choosing a platform that you can trust is very, very key. But if you were to choose from a centralized exchange like us, you have to look at the centralized exchanges proof reserve. If they have published proof reserve, if they are big enough and they are very transparent in terms of communication, that's a good one. You don't want to put your money at a centralized exchange that doesn't have proof reserve or not fully regulated, that doesn't build that foundation and trust.
Well, thank you so much, Gracie. So that's the advice from one of the world's top CX CEO of Bitget. So coming up, let's invite Gary to share his advice to our investors.
Thanks, Lucy. Well, I guess first of all, I really like what Gracie said about going back to core principles. We are talking about a question of investment. Investments always, there are two sides of the equation. There are the benefits that you perceive, and then there are the risks that you have to undertake. And like what we said earlier on, even amongst different CEXs, there are different risk levels that investors really are choosing from, as well as the perceived benefits. And obviously, as a regulated CEX, there are things that we think we're relatively good at doing. For example, when it comes to sort of the cost benefit between, let's say, more convenience versus being more secure. We know which side of the equation we always have to land on. We always have to pick security over convenience. For example, when it comes to speed and efficiency, once again, really there's no magic formula out there. We use cold and frozen wallets over hot wallets or warm wallets because of a bias towards security over things like speed and efficiency. But look, being very, very objective, this is also something that in the regulated space we have to learn not just from the technologists, but we also learn from our users. Our users also tell us that there are lots of advantages that they perceive in picking their CEXs from outside of the regulatory framework. And what are their reasons? Because a lot of our users tell us because of what they perceive to be better user experience. That is, there's no sugarcoating that. That is a reality that in the regulated space, we also have to accept. We can't always pretend that we know best, because if our users tell us there are certain product features and there are certain types of user experiences that are clearly preferred by the users in other parts of the global ecosystem, that is also something that we have to learn from. And I think mentioning ETFs, that's a really good one. Once again, it's a cost-benefit analysis. If any financial engineering, if you put more layers on top of an asset compared to fewer layers, there will be cost associated. The liquidity profiles of ETFs do come at a cost, because someone has to pay the market makers, someone has to pay the stock exchange to list the instruments, someone has to pay the fund managers, because ETFs are funds, right? So direct investing versus ETFs, it's not just a question of liquidity and efficiency, but there is also a cost question on top. So I think I fully agree with what Markus and Gracy said about certainly picking the more liquid, the larger market cap assets in the crypto space, because liquidity clearly is best when you're dealing with the top few assets. If for example investors don't believe they have the sophistication to manage their own wallets, then picking a regulated exchange is not a bad idea. For example, I think Markus mentioned when you're dealing with an institution, you are effectively benefiting from institutional buying power. And buying power isn't just about sort of buying en masse. It's also about the ability to undertake good, sophisticated due diligence on technologies, on the people you're dealing with, on service providers. That is something that we totally agree with. So I think really we always go back to the core. Really the core question we have to ask ourselves when investing: what are the cost benefit analysis? And if we see perceived benefits, if we weigh up the appropriate costs and the appropriate risks that we're willing to undertake, then sure, make the decisions on that sort of well-informed basis.
Well, thank you so much for the breakdown, Gary. I guess that's very clear. We need to consider factors like convenience, security, and liquidity. And these keywords are very good advice for our investors. So next up, we would like to ask Blue, knowing all the cybersecurity risks out there, how would you manage and safeguard your digital assets? Blue?
Okay, I think about investment, maybe I'm not the right person to give advice. Yeah, I also invested a lot of projects and buy a lot of tokens. But when I remembered them, the price is going down a lot. So I think maybe the good question is that when you teach me about the token, you should have told me when I can sell them. So it's a best strategy. Okay, I can give advice on if you want to buy tokens like Bitcoin and Ethereum and any other tokens. Maybe you should at first you should buy a hardware wallet, and you should use the top level exchanges like Bybit, Bitget, and others, I think. Okay, this is my own advice.
Thank you so much for your advice, Blue. So I cannot think about a better way to close the episode with Markus' future market prediction. So Markus, do you feel like the current downturn momentum will continue, or is it just a temporary adjustment? We'd love to hear your opinion.
I think over the next 1 or 2 months, I think the market is still struggling a bit. We have to really understand that, Wall Street is becoming a lot more influential in the Bitcoin, and, with 60% kind of dominance, really, it's still then influence for the whole crypto market overall. And when you look back, actually, Bitcoin was, trading well above 100,000 by middle of December. And this was really the time when, Fed Chair Powell turned, hawkish, right? The Fed cut, but it was a hawkish cut. And since then, the Bitcoin ETF inflows actually have turned into outflows. So this is when we really have seen, a lack of trading, volumes overall have come down since then. There was just like a brief moment, around like the Trump inauguration where, we had, of course, the Trump meme coin that has been launched. And of course, the price has come down a lot. So this has been, quite negative on the Solana ecosystem. So I think the momentum is a little bit gone. And I think it has to do more or less with really the Fed turning. So a lot of institutional investors, TradFi investors, they make decisions. They base decisions based on, inflation, which has come higher, based on, how the Fed perceives the market, which is also a little bit more on the hawkish side. So I think the market is struggling. And I think for us, the key dates are really when the next Fed meetings are, which is middle of March, early May, or in middle of June, really. And we think the market might struggle. And when you look back, last year we had like, two big pumps basically, right? We had a pump from end of January to early March, and this was also when Powell said we're gonna cut this year. So we had this pump really in Q1, and then basically when the Fed did the emergency cut in September last year of 50 basis points, then we started to rally, and of course the rally has accelerated when Elon Musk joined, Trump's election, speech in early October, and then of course with the Trump election in November. And the market is waiting really right now on news about the Bitcoin strategic reserve, where Trump has said, well, the team has like 6 months to decide what to do here. So this can really mean until the summer. So I think that's a little bit kind of the tricky environment, as I said earlier, that we're already seeing that these hedge funds unwinding really the long ETF versus the short future trade. And I think that's kind of like an overhang, especially because volumes are quite low. But nevertheless, I think we still probably go higher by sort of middle of the year and then towards end of the year, because something that we notice is actually the wallets that are holding 100 to 1,000 BTC, so basically 10 million USD to 100 million USD, that has actually become the largest holders as a cohort, more than the OGs, more than the 1,000, or the 1,000 to 10,000 whale holders. So, and that indicates for us probably that a lot of US institutions, a lot of US wealth managers are buying, and they don't really have to sell. I mean, they really hold it for the medium to longer term. I mean, that's exactly sort of like what BlackRock's message was, that Bitcoin is digital gold. So, and I think that's what we have seen every time, over the last, I guess, like 12 months, every time we have seen like a spike in liquidations, the market has actually reversed a bit. So we, of course, we think we can correct a little bit lower, but we do think because there is a new buyer now in the market, and this is really the 10 million to $100 million wallets, and they don't tend to sell. I mean, this is really a steep climb, and they have been the largest buyer. And that's why we think, we're going through this period, but also because we have been going sideways now for 3 months, and this is when volatility has come in. And, MicroStrategy is a key volatility seller. But of course, when volatility comes in and their own volatility of the share price has gone from 160% to just 60%, they cannot sell the volatility. So they cannot really raise capital right now, as they have done, because the NAV price, so the fair value of the stock has come down. The volatility that is embedded in the convertible bonds have come down. So this kind of prevents them from raising more capital. So I think that's where we're sort of in this holding period. And I think the Fed will probably turn dovish at one point this year. And I think then we're going to see another big leg up in Bitcoin. But if we are around 80,000 or 90,000, I think we're a little bit probably expecting we're going to trade a little bit more lower, but then we're going to rally towards middle of the year or end of the year.
Thank you so much, Markus. Always love your point of view in the market. Handing the mic over to Jack.
Thank you very much to all our guests and for the insightful contributions. And this incident of the Bybit incident serves as a stark reminder of the critical importance of security in the digital asset industry. Exchanges must continuously enhance their risk management and compliance measures. Further improvements to security mechanisms, such as stronger multi-factor authentication, enhanced smart contract audits, and optimizing fund storage methods are essential. And we believe this incident is not only a test for Bybit, but also a wake-up call for the entire industry to reflect on the construction of security systems, pushing exchanges to increase transparency and better protect user assets. So this wraps up for today's OSL talk. And thank you to all my guests today, for Gary, Blue, Markus, and Gracy, as well as Lucy as well, and all the crew behind, including Calvin, Sherry, Carter, and Julie. Thank you very much for coming up. And our live shows will continue to bring you the latest and the most comprehensive updates from crypto institutional space. So don't forget to subscribe OSL official Twitter and YouTube channels to stay updated and never miss out on our exciting content. So bye-bye. Thank you very much, guys. Thank you.